Welcome to our quarterly update. My name is Colin Beveridge and I'm the Chief Investment Officer at True Potential Investments. What I would like to do over the next few minutes is just talk about the various factors that have been driving markets and then conclude with some informative comments about the outlook going forward. So let's begin by just setting the scene and by considering our chart, which looks at market movements over the quarter to end March. If we look at the right-hand side of the chart, we can see the positive movements that have taken place. And here, emerging market and Asian equities, which includes Chinese shares, actually produced some of the biggest positive returns. US equities were also positive, as were UK bonds, which were quite strong over the quarter. Now, if we look at the declines, which are on the left-hand side of the chart, we can see that Japanese and European equities fell quite sharply over the period. Now, the UK stock market also dipped, but what was a particular feature was the weakness of sterling over the period against the US dollar and against the euro. Now, sterling has weakened in response to the debate around Brexit, which is effectively the possibility of a vote that the UK will exit the European Union. Now, oil prices, which were a particular feature last year as they fell extremely strongly in response to excess supply, appear to have stabilised a little bit. So that was, reasonably good news. So what's driving these divergences in markets? Well, when we take a snapshot over 3 months, it doesn't actually give us the full story. Because when we started the year, stock markets and indeed commodity markets and emerging markets as well were in free fall. Part of the reason for this was concerns about China slowing. It also fed into things like commodity prices and particularly commodity based emerging market economies. There were also concerns about US manufacturing, which seemed to be almost sliding into recession. And we had, as a consequence of all of this negative sentiment, it basically spilled over into European financials with some concerns about banks. Now, as sentiment soured, it's not unreasonable that central banks actually stepped in to provide some form of stimulus to try and encourage investor behaviour to be a little bit more positive. In Japan, the central bank moved to negative interest rates, to a negative interest rate policy. And in Europe, the central bank widened the scope of monetary measures and monetary stimulus to include the purchase of corporate bonds and not just corporate debt. And in the US, the Federal Reserve Bank, which is currently raising interest rates, made more dovish noises, more positive noises about the fact that interest rates in the US may not have to rise as fast and as quickly. So as a consequence of these more positive measures, markets rebounded sharply, particularly in the areas where investors saw pockets of value, more deep value. So emerging markets and Asian shares, as we saw from our chart earlier, rose the most. Oil prices stabilised. Now, oil price has been considered to be a bit of a proxy for what's going on in share markets internationally. So the fact that that stabilised actually helped equity markets more generally. So where do we go from here? Where now? When we talk to our manager partners, the consensus view we get from them is one of cautious optimism. They do see pockets of value, and as a consequence, they're looking to exploit them. Of course, there are risks. We all know that there are concerns about economic growth going forward, and there are also just the normal evolving threats and opportunities that occur day in, day out in stock markets. Moreover, one of the instruments that multi-asset managers use is government bonds. They point out that now government bonds tend to be used as a form of insurance within portfolios rather than managers being attracted to the long-term return. So in conclusion, when we try and pull all of this together, what does it actually mean? Well, I think the first thing is that breadth and depth of diversification is really important. And that's what we offer through our wealth strategy funds. We access some of the top managers globally, and we do know that they are nimble and vigilant to the risks that lie ahead. We also combine those different strategy funds into our own managed portfolio series, which we actively manage ourselves. One of the benefits of our managed portfolio series by combining the funds together is that it adds another layer of diversification by investment style. So in a sense, there is no single manager risk attached to our managed portfolio series. And we do this at no additional cost, and we do know that high costs just erodes investor wealth. So thank you for listening to some of my comments, and I look forward to speaking to you in the near future. Thank you.